All right, good morning, everybody. Thank you for taking time out of your day to listen into our webinar, which is going to be going over our 2018 Defined Contribution Survey results and also a focus on plan compliance and some issues that we commonly see in plans throughout the course of performing our audits throughout the year. My name is Marty Kirshner. I'm a manager at Gray. I've been at the firm for about 10 years now, and along with Jim, who will introduce himself in a second, we developed this survey, and we're excited to share our results with you.
Good morning, everyone. My name is Jim Donellon. I'm a partner at the firm. I've been here for about 12 years, and I've been doing benefit plans for the past 12 years as well. Besides the benefit plans, I also have a focus on consulting and audit work for company financial statements. So it's not just the benefit plans, but it is a huge component of our business.
Yep. And so this is the third year that we've done this survey, and just through this agenda that we have, we want to take a look at the results and, like I said, go into some issues around the plan, which is based on these results, and then we want to open it up at the end for any Q&A that everyone has. It looks like we have a really good crowd on hand today, so we're hoping that we get a lot of questions, and if we don't, then feel free to take the time after the webinar to just reach out to Jim and I directly, and we're happy to answer any questions that you have. So really just high level, looking at the size of the respondents that were surveyed, and as you can see, the bulk of it, about 80% of the respondents fall between 1 million and 100 million in assets, which is what we kind of expected. Just to give a kind of frame of reference over the past 3 years, what we've seen, that $1 million, below $1 million was up a little bit this year, and that's just a result of what we thought to be a lot of new companies, new plans. The 110 million and the 10 to 100 million, all pretty consistent. I think you can attribute some of the flatness to, growth. The job market was up this year, but if you look at the market performance, it was a little bit down, which would have offset any real increases to contributions and plan size. So just looking at the 3-year trend here, while the bulk of it still falls between 1 and 100 million, you're not going to see as much of a fluctuation as we would have expected to see. We probably would have thought to have seen more of a spike in the 10 to 100 million. And really we attribute it to market performance because that impacts the size of the assets in the plan. However, when you take it to look at the number of participants in the plan, this is the breakout that we're showing here on this slide, and half of the respondents had plan sizes that fell between 100 and 250 participants. We also noticed an increase in the less than 100% category and a decrease in the over 1,000 from last year, which if you look at this slide here, this all kind of makes sense too, because we expect some of these companies to shift from one bucket to the other depending on where they fall in terms of, again, employee growth. The job market is as strong as it's been. The economy is great. The unemployment rate is low. So we're expecting to see some of these plan sizes go up, and we're also assuming that the respondents to the survey, and I think I mentioned before that we have over 100 respondents annually to the survey, that it's a consistent set of people so that you can kind of get a nice 3-year trend. So everything that we're seeing here is what we expected to see. And then just to give kind of a breakdown on what industries respond to the survey. So again, 28% fall into that professional services, which can be all sorts of things, whether it's engineers, lawyers, accountants, consulting firms. So a lot of companies fell into that bracket. And then one of the bigger industries that has kind of made its way up the chain is the biotech and life sciences. We noticed a lot more respondents in that sphere this year, which, biotech is a very, for lack of a better word, a lot of buying and selling in that industry, a lot of new companies forming and spin-offs. So, within our client base, we have a decent biotech conglomerate, but it fluctuates every year. And last year just happened to be a big year for respondents and for us personally in terms of the types of plans that we were auditing as well. The next slide that we wanted to focus on was matching contributions. So, based on what you see here, 75% of respondents pay their match each pay period, and 25% pay their match once a year. What I wanted to stop and, fill you in on too is that if you look at the survey results, which we will be releasing, sometime I believe in the next few weeks is that the bulk of companies these days are offering an employer match. It's pretty much commonplace. When it's a down year and the economy's down, you will notice companies either suspend the match or lower the match, but that hasn't been the case here. And it's been a huge recruiting tool in the workforce. People are placing a higher level of value on retirement and retirement benefits, and just through education and a lot of the consultants we've worked with, and them going out to mutual clients and teaching them about retirement education. People are putting more of a value into putting money aside then, and understanding the value that a company is giving when they will fund you an employer match, and the concept of free money. So and the most common match that we saw in our survey results was that most plans were matching up to 3% of an employee's compensation, 100% of that, and then all different variations to either get there, some higher, some lower. But this was the most prevalent match that we saw in the survey. And with the vesting, what we noticed was that 27% of the plans surveyed have 100% vesting in their employer match, which is also it's a good retention tool. A lot of companies have the graded vesting, which, as you can see below that, is broken out based on number of years of service, and it can oftentimes take 6 years for someone to become fully vested, which is probably not as common as it was years ago with the millennial workforce and their desire to change over jobs frequently. And so that's why we've actually seen an increase in plans doing 100% vesting right away as more of a retention tool to incentivize some people to stay at the company longer, so they get the benefit of the free money for longer.
So another thing we wanted to touch upon is just some common issues we see when we're doing these audits. And it's not just us that are finding these issues. Also the DOL, they're sampling some plans each year, and they're doing their audits, and they report their findings. So a lot of the common issues we see in our plans that we audit, the DOL is finding in other plans as well. And really the important thing here is that the plan sponsor ultimately has the fiduciary responsibility to make sure the plan is operating properly. So you can't just fall off of blaming the TPA. It's their fault. They didn't know what they were doing. The plan sponsor has to be working with the correct advisors, selecting the right TPA to make sure that the record keeping is being done appropriately, and taking that responsibility. So the reason we have this experience, we're auditing over 90 plans each year. These plans consist of primarily 401k, 403b, ESOPs, and then we still have some defined benefit plans, some DB plans. A lot of them are frozen. So you don't see as many of them out there anymore. They absolutely still exist. And with this experience on all of these plans, we've noted there's a lot of consistency with the issues we see from plan to plan. So we're going to go over that in the next few slides. And while not all plans need to be audited each year, they still need to be operating in accordance with the plan documents, in accordance with IRS and DOL regulations. So it's very important whether you're a small plan or a large plan. So eligible compensation, that's been a hot ticket item for several years now. And the key here is knowing the plan document. That's what governs the plan operations. Eligible comp is something that is specifically outlined in the plan document, and it should be specifically followed to ensure the plan is operating properly. We always recommend to our clients that they ensure the various compensation codes are set up appropriately within your payroll system, so it's not a manual process each pay period to make sure that the proper withholdings are happening based on the eligible comp. The key here is that once the codes are set up, that they match the plan document. So it's not just making your own decision of what you think should be eligible or ineligible. It's making sure it agrees with the document. And then this should be checked periodically, because you never know, 6 months from now there might be a new form of compensation that wasn't initially set up in the system. And one of the things we often see here is that there's some non-recurring compensations, such as commissions or bonuses, which may be eligible according to the plan documents, but erroneously they're considered ineligible. And it's really just because sometimes sponsors don't know how to handle it, because it's not something they're dealing with on a regular basis. But it's important to understand the plan document and ensure you're following it. We're going to continue to stress that. For example, if there was a bonus that a participant was not given the opportunity to defer on, it could become costly to the sponsor as they are forced to take corrective action. In some cases, the plan sponsor not only has to credit the participant accounts for any missed matching contributions, but they might also have to put in an additional contribution to the participant's account for the lost opportunity on the employee contribution missed.
And just to add on to that, from our experience, there's no real statute of limitations. if the error is identified, they're going to ask you, we've talked to ERISA attorneys and retirement plan consultants, and, the general ask is that you go back as far as you can reasonably figure out that data available to figure out how many years you have missed, especially if it's a bonus and you hadn't been deferring on it, how many years those missed deferrals are. And to Jim's point, it has been very costly for some plans, and it's something that we stress. It's always a thorn in the side of the audit because eligible compensation from plan to plan is not consistent. Some companies offer certain things, whether it's restricted stock or fringe benefits that somehow find their way accidentally in, and it's kind of a process to unwind it. So going to your consultant at the end of each year, whoever has the most knowledge of your plan document, and making sure that your eligible compensation is 100% correct is a very worthwhile exercise to do. So we just can't stress that enough.
So getting into the survey results as they relate to eligible comp, from those who responded, the bonus compensation, 79% of the plans considered eligible compensation, and in 21% it was not. So in all those cases, it's important to make sure that you're treating that appropriately, and the plans that say it's not eligible, that you're not giving the participants the availability to defer on that, because that would not be in accordance with the document. And then the other component of that, now you've identified that bonus comp is eligible, now you need to look at the document to see if there's a separate election. So if there's a bonus being paid out in Q4 and somebody's deferring 10% each pay period, are they given the opportunity to make a separate election and identify, I'd rather put a little bit more away from this bonus since it's really extra money I've come into. So in all of these cases, again, it's know the plan document, make sure you're treating it appropriately. One thing you could do in terms of the election forms is you could consider having a default election if the separate election form isn't returned, whether it be it defaults to no withholding or defaults to the regular withholding elected for all other forms of eligible comp. This is important in case you have a participant come forward claiming they missed out on an opportunity to defer and to support the plan operations in the case of an audit. And again, that's not just a CPA firm doing an independent audit, it's also if the DOL or the IRS records come in. And again, this is assuming these elections don't conflict with any other aspects of the plan document. And besides bonuses, some other types of compensation we often see mishandled are overtime, commissions, stock compensation. Whenever you're unsure, always check with the plan document and/or your advisors for help. This is an important benefit for your employees, and you want to make sure the plan is operating properly. Not only is it helpful to the participant, but it also helps the plan sponsor avoid additional costs associated with lost earnings, penalties, additional inquiries under audit. And besides the potential penalties, it also takes up management's valuable time to deal with these issues. So here we have a snip from an example of a plan document. Now, all plan documents are different. Yours might not have a grid like this. It might be written out in Word form and be more driven by sentences. So this is where you would go to see what the different types of compensation are and what is eligible and what is ineligible. And then we also included an example of what it looks like if there's a separate deferral election for bonuses. So again, the key, looking at your plan document, it's also very important to be looking at the most recent document. I've seen plenty of cases where there are amendments made over the last few years. There's a new plan document out there, and we've seen folks that are still utilizing plan document from 7 years ago, and then they're not following the actual updated document. Another key piece we've seen missed in some cases is a true-up. So if you have an employer matching contribution, there's an election to be made what the contribution period is that's going to be calculated on. So that could be calculated based on the month, the quarter, the year, the payroll period. We see a lot of clients that do it based on each pay period. However, there's often folks that select to do it over a plan year. And when you do it over a plan year, you have to do what's called, you have to identify if there's a true-up contribution needed. So that's something we see overlooked, in that somebody could have been maybe maxing out throughout the year, and what a true-up does is it smooths that out over the year and figures, it does the math to see if they missed out on the opportunity for an additional match if they had more evenly contributed to the plan throughout the year.
So the next slide talks about hardship distribution. So virtually all of the plans that surveyed allow for hardship distributions, and that makes sense to us because, again, in our experience auditing these plans, we rarely come across a plan that doesn't allow for hardships. There's a 10% one-time tax on those, and the most common hardships, as for those attending who are most likely aware, is medical expenses, purchase of your primary residence, avoiding foreclosure, funeral expenses, and post-secondary education. So a lot of times in the course of our audit, we would make sure that we would see support for these common hardships, and the responsibility of the plan administrator was to always have documentation of the hardship, whether it was a letter from a landlord that was going to show eviction, whether you had a medical bill to support it. The other things that we ran into, the prior rule is you had to exhaust all quote-unquote financial avenues before taking a hardship. For example, had you already taken out all the maximum plan loans that you were allowed to? And lastly, the other rules around hardships were around suspending deferrals for 6 months and making sure that that was turned off timely and turned back on timely. And that was another common issue that we would see in our audits and that we heard in some of the general feedback in performing the survey. Now, as most of you are aware, starting 1/1/19, the IRS and DOL came out with some more, call them lax rules around hardship distributions, and changed a lot of the requirements, which should help reduce the number of issues that we have in audits around these. So as I had mentioned originally, you needed to have documentation of the hardship. Under the new rules, if it's too difficult to obtain support for that hardship, the participant just needs to put in writing that they have insufficient cash or resources to satisfy the immediate financial need and sign that. And the plan administrator can now rely on that as representation that there is a legitimate hardship in place. As I mentioned before, you had to take out all participant loans before you could take the distribution. Now you're able to take that distribution out without taking the loan. So again, you don't have to go through all these hoops just to get that money out. They also relieved the 6-month suspension of deferrals, so you can still continue to defer as soon as the hardship is taken and not worry about getting it turned on or turned off. So it's one less thing for the payroll department to have to worry about. So now this is actually effective 1/1/20 as a rule, but you can amend your plan for 1/1/19 to allow for the removal of the 6-month suspension. So that will be at the discretion of the plan administrator. And also in the past, distributions of your account could only be taken out for certain things, and some of those things that were excluded were the earnings on your employee deferrals, any QNEX in your account, and any QMAX. So now those are all eligible for distribution of a hardship. There's some other rules there. Oh, and then on that fourth rule, I forgot to say it, that only applies to 401ks. The rules right now do not, for that distribution of earnings and QNEX is not currently implemented into the 403B rules. And I know that they're going back and talking that through, but right now that is not applicable to 403B plans. Other things that we noticed in looking at some of the research on the rule changes was that you can add a primary beneficiary under the plan as an individual for whom the qualifying medical, educational, and funeral expenses may be incurred. So it doesn't necessarily need to be you that's incurring the hardship. It could be an immediate, family member, whether it's a spouse or a child. Also, some of the new tax laws on casualty deductions, so damage to a principal residence that would qualify for a casualty deduction under Field Section 165 does not have to be federally declared disaster area, and adding a new type of expense to this list relating to any damage to your house incurred from a natural disaster is now eligible as well. So I would actually consult with your tax professionals when it comes to any damage that you incurred to your primary residence from any kind of disaster, any casualty losses that you incurred as a result, to see what kind of deductions you're eligible for under the new tax legislation.
So another common issue we run into relates to the remittance of employee contributions. So the Department of Labor, the DOL, their rules require that the employer deposit employee contributions to the trust as soon as the employer can. And within that, the caveat is in no event can that deposit be later than the 15th business day of the following month. And the key here is that the 15th business day of the following month, it's not a safe harbor for depositing deferrals. That just is the maximum deadline. So you would have to prove out to the DOL, and that no matter what your support was, they would not be on board with it if it was taken beyond the 15th of the following month. There is a safe harbor rule for plans that have fewer than 100 participants. It's a 7-day safe harbor. So as long as you're below the 100 participants and you're making your contributions within 7 days, you're not going to have any issue. However, if you have over 100 participants, or if you're a large filer, which the easy way to know that is if your plan's being audited, then you're a large filer. There is no safe harbor rule, and then it needs to be done as soon as administratively possible. Now, sometimes there might be a reason why it wasn't remitted as soon as it is typically remitted. For example, you maybe had a change in your payroll system, you switched 401k providers, there was some severe weather, and there could be some others. However, the reason that so-and-so was on vacation and we had a firm outing that week would likely not hold up in the case of a DOL audit. When you do have reasonable exceptions, you should put a memo in your files as to what occurred and the reason for the delay. We often quickly forget the reason behind certain delays when several months or years pass, so a memo provides more clarity and support in the case of an audit. Continuing along with the theme of common issues, enrollment is another issue we see, and automatic enrollment is the biggie. So while it's great to get participation rates up and oftentimes helps reduce discrimination testing failures, you need to make sure your system can handle auto enrollment. We often see plans implement auto enrollment and then certain employees are put in too late, or there are inconsistencies with the process of enrolling the participants. The key here is when participants are not entered timely, it can be costly to the employer, both in terms of time spent correcting and the dollars spent contributing to missed opportunities. And now there are certain rules where if you catch it within a certain period of time, the contributions are very minimal, and then kind of the older it gets to correct, that's when it becomes more costly. Some plans also have an automatic escalation clauses where participants can elect to increase their deferral percentage automatically each year until it hits a certain ceiling. This is beneficial to participants so that they can time it to have their percentage increase around the same time as their annual pay increases, so they don't get used to the additional income. However, adding this clause causes the need for more oversight to ensure the systems can handle this additional feature. We also see occasions where the eligibility requirements aren't strict enough. For example, it might be a staffing company or really any industry that has a lot of turnover. You don't want to have a short eligibility requirement because this will result in a higher number of active participants, which could trigger an annual financial statement audit. In this scenario, you likely want to have a requirement of 3 to 6 months or a certain number of hours to be worked. We've seen that multiple times where we've had organizations that they get over the 120 threshold, so they need an audit. And the issue, once you get over 120, you can't get out of the annual audit requirement until you get below 100. So the key is whenever there's something you can do about it is to keep yourself below that threshold. So in terms of our survey response, 45% of the plans currently have auto enrollment that responded to us. So a lot of plans out there are using it. And this is great. It encourages participation. It also helps highly compensated individuals keep money in the plan. In other words, really the higher the participation and the higher the contributions by non-highly comped employees, it makes it easier to pass your annual discrimination test. The most common initial contribution percentage we see is 3%, but there's often a variety. Often these plans combine automatic enrollment with auto escalation, so participants might, for example, be automatically enrolled at 3%, and then it goes up 1% each year until a certain cap, which may be 5, 6%. From there, participants must make changes themselves online, usually through the third-party administrator's website. Just kind of focusing on auto enrollment, kind of making a pros and cons list. So again, the primary benefits of automatic enrollment are you're going to increase participation, which in general may reduce discrimination testing failures each year. It also simplifies the investment selection process, as typically the contributions default to a life cycle fund based on the expected year of retirement. Participants are also less likely to opt out of enrollment than they are to choose to enroll in a plan that doesn't have automatic enrollment. In other words, people generally might want to join the plan, but they don't feel like dealing with the paperwork and they don't go through with it, whereas if you automatically enroll them, they're less likely to decide to fill out the paperwork and bring themselves out of the plan. And really from a financial standpoint, it's healthy for employees to be saving for retirement as soon as possible so they can benefit from the time value of money. However, there are also some potential drawbacks to automatic enrollment. So while plan management won't need to continually remind employees to enroll, they will need to focus more time on ensuring employees are being automatically enrolled properly. So you really need to have strong systems in place to ensure participants are not being enrolled late or not enrolled at all. As we mentioned earlier, this results in additional time spent correcting the failure and may also cost the company money in terms of corrective contributions. So really the last several slides, we were really going over compliance issues we see in our audits. And we also asked this of our respondents to see really what issues they've found within their own plans. We see a lot of commonality, so late remittances, eligible comp issues, enrollment issues, but a couple others that of note here, incorrect vesting, and yeah, that's important. You can't shortchange participants. So if they take a distribution and you didn't give them their fully vested amount, that's a problem. And vice versa, if you're giving participants money they didn't earn, while that one participant really wasn't given a short straw, the rest of the plan did, because oftentimes that unvested money gets forfeited back to the plan and it may be reallocated to the active participants. So those participants theoretically are missing out on that money. So the missing minutes, that is something we often see. So you really need to be meeting periodically with your advisors, and those meetings should be documented in minutes. If you're ever being audited by an outside firm or by the DOL, if they come in and a decision was made, it's important to have the minutes to document those decisions.
So transitioning over here, we're just going to talk about non-discrimination testing real quick. It's not going to be seen in the survey, but we do ask, we look at not only our clients, but the people we survey, what percentage of them have failed their discrimination test during the year. And it's always something, we get a lot of feedback at the end of the year where, clients aren't happy that they have to kick back money to participants. Participants aren't happy that they have to get that money back. And so we always try to give them ideas on what they can do to avoid failing non-discrimination testing. And so some of the most common fixes that we have are increased participation, which really can be triggered from auto enrollment. We've seen auto enrollment go up a lot over the past few years. It has become almost, I would argue, commonplace in some plans to have the auto enrollment feature. And so by having that, you have higher participation in the plan, which will then make the plan less top heavy. And then, with those features, making sure that you have an auto escalation in there so that if, your auto enrollment is initially 2%, that it's not 2% every year, that they have to be escalated to 3%, maybe 4%, and then you get capped. And it's on the participant to take the time to opt out. And what we've seen is that most participants don't opt out, even if they didn't want to participate in the plan, either because of the administrative labor of having to take the time to go opt out of the plan, or because they just needed someone to kind of force them to start saving for retirement. So they rely on that. Increasing employer contributions, while costly, is also another way to incentivize participation in the plan. It all goes back to what I was saying before on employee education and making them realize that when they're getting an employer match, that is their company giving them free money. And while they don't get the benefit of receiving that as an immediate paycheck, it is money that they will have put aside for the future. And truthfully, they could take it out if they wanted to. They're just going to pay taxes on it now as well. But really making sure they understand the generosity of their companies when they're giving the employer match is important. And then if you want to not fail your discrimination testing, your other option is to become a safe harbor plan. And so that is also a very costly decision for a company to make, because that really means that you have to fund a percentage of their compensation every year or their match, and it's usually a high dollar amount. And so most companies opt not to do that, but other companies that have strong cash flow or strong performance will opt to do that. And so it's just another option to get out of having to have excess contributions refundable at the end of a year. Transitioning now into the different types of audits, so we talk a lot about compliance in terms of plan operational issues. A lot of times we get questions on, the type of audit that they're getting and what it means. So there's the audit that we typically see is the limited scope audit, which is the requirement of the DOL. And it's really more of a compliance audit than it is your traditional financial statement audit, which is more of a materiality audit. Now, within a DOL audit, you're still factoring in materiality, but as Jim had mentioned earlier, it's really more important that you're focusing on compliance with the plan document. So that is the big difference. And then the other big difference between the DOL traditional limited scope audit and the financial statement audit is just the type of opinion that is expressed. Traditionally in a financial statement audit, all things are equal. You're usually issuing an unqualified opinion. With the DOL audit, we issue a limited scope disclaimer of opinion, which is basically we're not taking any responsibility for the investment activity as it's certified by the institutions that are holding the assets and recording those transactions. So, and it's all done in conjunction with the ERISA Act of 1974, as many of you know. It's just kind of a history lesson there. And we talked briefly about the audit requirement. So, if you hit over 120 eligible participants, an audit is required. And I want to emphasize the word over because a common misconception is it's 120 or more, and that is actually incorrect. It's over 120. So if you have 120, you can still have the ability to file as a small plan. So make sure that you know that number. Make sure that whoever you're working with who files your 5500 knows that number so that you don't do an audit for nothing, because that would obviously probably not be the best use of time or money unless you really want to make sure that the plan is running as a well-oiled machine. If 100 or more eligible participants on the first day of a plan, if the plan is formed and at the beginning of that time period there's over 100, an audit is required. And as Jim had mentioned earlier too, once an audit is required, you can't get out of the audit requirement until you are under 100 eligible participants. Something that we always recommend too, if a plan's getting close to that audit threshold and they don't necessarily want to go through that process, is looking at your cash out provisions, because most plans nowadays are written such that if you have $5,000 or less or $1,000 or less in your account, that you're automatically distributed that amount, and that will help keep the employee headcount at a more manageable number.
And one key thing here is the term eligible participants. So it's not just how many people are in the plan actively participating, it's how many people are eligible, meaning current employees who are eligible but haven't elected to join, current employees who are in the plan, and then former employees who still have money in the plan. These are all considered eligible participants. So that all gets factored into the equation.
So while we're always considered the auditors that come in and make sure everything's going right, the plans are also subject to DOL and IRS audits, and most commonly with a lot of the plans we work with, they will, if they get picked to get audited, it is by the DOL. And so the DOL will come in and request certain records that you either provided already as part of your audit with your third-party auditor, or they might request other stuff. But some of the most common stuff that we see them request is plan documents, records of the plan, contracts, the filings, and as Jim had mentioned, trustee minutes, which is important. And so they're going to go after those things because that's really what they look at to make sure that the fiduciaries of the plan are operating within their fiduciary responsibilities. So these are critical items that you want to have, not just for us as auditors, not just as DOL as auditors, but also as the plan administrator, as the fiduciary on the plan, to make sure that you are operating in compliance with all the laws and regulations under that ERISA Act of 1974. So with that, I want to take it over to questions. We do have some questions coming in here. If there's a question and you want to ask it, please go ahead.
And so at the moment, we have a couple that have come in. The first one, the question is, my plan had 112 participants at the beginning of 2018. Does it need an audit? So the quick answer is it depends. So if your plan has been around since before 2018, then the answer is most likely no, because then if you filed as a small plan the year before, you can continue to elect to file as a small plan until you get over 120 eligible participants on the first day of the year. However, if your plan was just started in 2018 and you're over 100, then the magic number is 100 and you would need an audit. So we're happy to discuss that offline if you want to discuss it any further.
Okay. Another question we have here is just to confirm under the new hardship rules that participants, in fact, do not need to provide support of the hardship. As I mentioned, yes, if it's difficult to obtain the documentation to support the hardship, as long as the participant has a signed representation that they are suffering a hardship, the plan administrator can rely on that and make sure they have that signed document in their files in the event of any kind of auditor coming in as support that they have documented their understanding of the hardship and provided that as an avenue for that participant to receive the distributions. So with that, if there's any other questions, I don't see anything else popping up here. If you do have questions, like I said, you can email Jim or myself directly. Our email is on the screen right now. we just wanted to thank you for taking time out of your day to listen to this, and appreciate that and your support of Gray, Gray. So if there's nothing else, I wish everyone have a great rest of the day.
All right. Thank you, everybody. Take care.